All right. So chapter 23 is about flexible budgets and standard cost systems. Can somebody define the term flexible for me? What? Bendable. Now, doesn't that sound like something you want in all budgets, is their ability to sort of bend them and manipulate them whatever way you want? That's not really what this means, but it sort of is, and it'll be clearer as I get into it. So we already know that managers use budgets for planning and controlling business activities. Okay, so planning means what you think it means, saying what do I think is going to happen in the future, and stating this is what is going to happen in the future. And then controlling just means holding people to a budget or holding people to a plan. Okay, that's really what managers do. When people say I'm studying management, and I say, well, what are you going to do as a manager? And they're like, I don't really, I mean, like that. We tend to think of management and leadership in businesses as something that's like, that doesn't require any training. You just kind of go do it. It's funny, right? We think if you want to know how to do accounting, you have to go to classes and learn processes and learn sort of the standard way of doing it. But whenever we promote people to leadership, we often just sort of like, here you go. You're the leader now. Really what managers do, more than leaders, leader and manager are not the same thing. Managers have to be leaders, but oftentimes there are people who are leaders who aren't managers. Right? The person who's just your coworker, but who kind of guides a lot of things at work just because of their work ethic or the way they do things. What managers do is they create a plan and then they control, or they try to hold people to the plan. That's what management is. Okay? So I've already told you kind of about the way that we budget here at the college, where from the lowest levels we say here's what we're going to do, we pass it up the chain, they approve it or don't approve it. If they don't approve it, they come back to us, we work it out until finally this huge master budget is created. So once the plan is in place, that's the master budget, now we have to start acting on it. Have any of you ever tried to do a budget for your own personal finances? Yes, I see some yeses. How many Boy Scouts do I have in here? You remember the personal management merit badge? Personal management merit badge, you have to write down what you're going to do with your money, the amount of money you think is going to come in, the amount you're going to spend for 13 weeks, which to a 14-year-old or 15-year-old kid is like something they can't even conceive of. And then each time you get money, you're supposed to write it down, and each time you spend money, you're supposed to write it down. And at the end, you're supposed to compare what your plan was with what actually happened. And unless they do it with a 12-year-old kid who actually gets no money whatsoever for 13 weeks, there's always variance. There's always some difference between the plan and what happened in real life. As you've done that with your personal budgets, have you found that to be true? Has anybody ever been able to like perfectly stick to a budget? No? Why not? Because crap happens? Is that what you just said? Life has unexpected turns? Is that what you said? Yeah, right? I mean, things you didn't expect. Not always bad things too, right? Like maybe your family went on a family trip, and so you took some of that money you were going to save and you bought yourself some snacks. I don't know. Life's better with snacks, right? Anyway, so you act on the plan, then you control. So control means I compare what actually happened to the plan and then ask myself, why did that happen? Is it a necessary thing? Like, is that just the truth of things? So, you ever seen that with your own personal budget? Like you just kind of underplanned for certain things? Like maybe when you came to college, you thought, okay, I've got my tuition covered, I've got a place to stay, I should be good. And then you got here and found out that textbooks cost as much as tuition, or almost. So when you're doing the control part, which is comparing the two, you think, okay, textbooks, I'm going to actually have to plan more money for textbooks next time. That's not because I overspent, it's because that's what books cost. Or maybe when you're doing your controlling, you think, oh, I went out to eat a lot. Shouldn't have done that. I didn't really have the money. I need to control that better. So I'm going to put some things in place. I'm going to put a rule for myself. I'll only go out to eat, once a week, or whatever you kind of plan as your own thing, or never if you can't afford it, right? Then feedback and identify corrective action. That's the rules you put in place for yourself for the next part of the cycle. And you get better and better at it. Okay, both at the personal level and at the business level. So that's what we do with all these budgeting activities. That's the whole point. So you learned about the master budget last chapter. It's a static budget. the term variance means the difference between the actual amount and the budgeted amount. And then the static budget variance is the difference between the actual results and what we planned, okay? So when we talk about variance, variance can either be, and this was actually covered in the last chapter, so this is just review. Variance can either be favorable variance or unfavorable variance. You notice it doesn't say it can be higher or lower, because depending on the thing, revenue that is higher than what you budgeted for is a favorable variance. But expenses that are higher than what you budgeted for, that'd be an unfavorable variance. Does that make sense? So you got to not think about higher or lower, you've got to think about, is this a good thing or a bad thing? Or a favorable thing or an unfavorable thing? All right. So this is called a performance report. Again, I think they showed you the concept in the last chapter. So it just has the actual, it has what you budgeted, and then it has the variance. That's all. So a flexible budget, a budget that's bendy. Really what a flexible budget does is it adjusts the fixed budget to the level of activity that actually happened. In other words, if we planned to sell 50,000 units and planned our revenue and our expenses accordingly on our original budget, then we did the work for the year or for the month or whatever the budget was for, and we actually sold 52,000 units, it may not be that valuable to compare the numbers, the revenue and expenses, against that fixed budget, which was based on 50,000 units of sale. So with a flexible budget, what we do is we adjust that fixed budget to a 52,000 unit budget and say, well, what revenue should I have got if I sold 52,000 units? What expenses should I have expended if I'd sold 52,000 units? And then we compare our actual against that, okay? So in order to do that, we have to have a budgeted selling price per unit so that we can adjust to changes in actual sales volume, and our variable costs per unit, and our total fixed costs. So almost what this does is, do you remember the CVP, cost, volume, profit chapter, and then the master budgeting chapter? It takes the concepts of the two of those and brings them together in this chapter. All right. So here's how we prepare a flexible budget. So we could see if we budgeted, here they've made 3 different budgets based upon different units of sales, 48,000, 50,000, 52,000. So you can see sales revenue is going to change accordingly, right? If we sell them for $750 a piece, then our sales revenue is going to increase as we sell more units. Our variable costs will also change. If we sell more units, our variable costs will go up. And then our fixed costs, they'll stay the same regardless of the number of units we sell. Once we know that, we can create a flexible budget. What really matters to you as a manager is not that there was a variance, but why there was a variance and what can I do about it, right? If there was a favorable variance, then you're like, how do I get more of that? What happened to cause the favorable variance, and how do I get more of that? If there's an unfavorable variance, the question is, what caused that and what do I do about it to reduce that? It kills me the number of people who are accountants who can't freaking think this way. They think in terms of numbers only. Oh, those numbers are higher than they're supposed to be. Thanks, genius. How do I fix it? That's what really matters. That's what means the business survives or dies. You know, oh, our accounts receivable is higher than it should be. Thanks, buddy. Go back to your cubicle. I guess it'll be my job as the manager to figure out why that is, put a plan in place. And that's why there's financial controlling, and then there's kind of activity controlling. We make activity-based plans, right? We call those operational plans. If my accounts receivable is too high, I'd have to make a plan, right? Maybe I'm going to call each person that owes us money personally and ask them to pay us. You'd be surprised how effective that is. Just calling them and saying, hey, you're over 30 days. Will you pay me? Right? So that's the other part of the manager's job. They have the financial planning and controlling, and the operational planning and controlling. All right, so let's take a look. That's dumb. Let's take a look. All right, so here's a flexible budget performance report. So it's broken into these columns. Don't let them scare you. The first column is amounts per unit. That would be for our revenue and our variable costs, right? Because there's no per unit amount to worry about for a fixed cost. Then the first numbered column here is actual results. This would be looking back, what did we do during the month? In this case, they sold 52,000 units. Okay, so they have their revenue, they have their variable costs, their fixed costs. Then they, over here on column 3, they have what's called the flexible budget. That's the static budget that they originally made, but adjusted to 52,000 units of sales. How do we adjust that? Well, we just take 52,000 units, which is our actual results, and then multiply it by our variable budgeted amount, $7.50 per unit in sales, and then $1.75 for direct materials, etc. Okay? The difference between our actual results and our flexible budget, we call flexible budget variance. In the fifth column, we have the static budget. That was just the budget that was the best estimate of the managerial accountants before the period began as to how much stuff we're going to sell, 50,000, and then the revenue and expenses based upon that. The difference between our flexible budget and our static budget is called sales volume variance, because the only thing that should account for differences between those budgets is the sales volume. Okay? All right. So you could see if we got rid of flexible budget and we're just comparing our actual results to our static budget, it would look like we had a $15,000 favorable variance in revenue. The problem with that is, of course we had a favorable variance in revenue because we sold more units than we originally planned. So the reason we do a flexible budget is so we could say, okay, if I had sold 52,000 units, then what should my revenue have been? And the answer is it should have been 390,000, but it was only 384.8. So I've actually got an unfavorable variance there. So now I'm asking myself, okay, so if just because I sold more doesn't mean I necessarily did better. I actually brought in less revenue than I should have for sales of 52,000 units. And that gets to the heart of where a manager says, why? Are we selling these discounted? What's causing that, right? Our sales price is $7.50 a unit. We got to understand why, so we can go back and either correct or say maybe it's worth it. Maybe we sell 2,000 more units because we're still doing better than we thought we did overall. Okay? Same with expenses. So direct materials, if we were to compare our actual results to the static budget, we see we had an unfavorable variance. And if we compare it to our flexible budget, it's still unfavorable. In fact, it's more unfavorable. You'd be surprised at the number of businesses who think the sole answer to fixing my financial problems is to sell more stuff. Well, these guys, I don't know that it's helping them. So far, what I've looked at is by selling more stuff, they have 2 unfavorable variances. Okay? Direct labor, if we compare actual results to sales volume, to static budget, we'll see a $6,000 unfavorable variance, we'll see about a $4,400 unfavorable variance between those two. But if we compare it to the flexible budget, we have a $10,400 favorable variance. So apparently our increasing volume is saving us money here, direct labor on variable overhead. The bottom line really starts to matter, the operating income line. Our actual results of $36,320 when compared to our static budget are actually an improvement. But of course it's an improvement, we sold more stuff. But our flexible budget variance says, hey, at 52,000, we should have made $37,000 in operating income. We made $36,320, so we have a $680 unfavorable variance. So what this tells me, this whole report, is that while I did better overall than I would have if I'd only sold $50,000, 50,000 units worth of whatever I'm selling, I didn't do better than I probably should have for selling 52,000. That doesn't mean I did something wrong. It means there's probably some things to address or adjust. because that variance at the end is only $680. Well, just my revenue variance was $5,200. If I can get that under control, I'll be favorable here. I'll be ahead of even what I was supposed to do for selling 52,000 units. Okay, so this is really valuable. The more you understand the numbers, the more you can start to make decisions. Why am I not collecting as much as I thought I should have on these? Why are my direct materials costs so high, and what can I do about them? Because before you start going for higher volumes of sales, you've got to get your costs under control, especially your variable costs. The fixed cost doesn't matter. But if you can get your variable costs under control and your variable revenue under control, then sell more. Sell lots more if you can. So you can see they're a little bit unfavorable, but not bad. And certainly better than if they'd only sold 50,000, what we planned for. So the second concept in this chapter is what's called a standard cost system, which is the price, cost, or quantity that is expected under normal conditions. Of course we use that because we have to have some basic estimate of what things are going to cost. That's dumb. Okay. All right. So usually the standard costs that we're going to use are set by the purchasing manager for direct materials, for direct labor, the human resource manager, for overhead, the production manager. Whoa, wait a minute. 3 different managers have to get together in a meeting and hash out what the actual costs or the standard costs are going to be? Yeah, you got to talk together, right? But it makes sense. The person who does materials is the person who buys it. They know what it costs. The person who does labor is the person who manages everybody's salaries and payroll, etc. Okay? All right. So this is kind of dumb, and there'll be like stuff in the book to do, but like this is kind of obvious. And so most of the time it's going to tell you like the purchase price is this and the delivery price is this. So what's the standard cost? Well, let's add them together. That gives me my standard cost. Same thing, direct labor cost. We know how the hourly wage is. We know how much the payroll and tax stuff is, etc. So there's nothing new here. So that's what standard cost systems do, okay? They just make it easier to make your budgets, to set your targets, because you have a good estimate of what the costs are going to be, okay? And like I said before, what it really does, it lets you say, okay, here's what they actually were versus here's what we set them at. Why is it different? Is it different because it has to be, because that's just what things cost now? Then we'll adjust our standard costs higher. Is it different because of something we're doing that we can fix? Then we'll put in operational plans to fix that. Think about everything in your life. That's how things are. When something is different than what you expect, right? When you go in for that first kiss and she responds in a way different than you expected her to, you've got to do a variance report, right? You've got to say, okay, what accounts for the difference here? Was it my breath? Was it my timing? Was it that she's just not into me? What is it? What was it? And if it's something like she's just not into me, then your choices are like operational plan. Try to get her to be into me or cut and move on, right? Those are kind of your choices at that point. Because then try to get her to be into me takes like all sorts of planning, and it's not sure how worth it is. You have to decide, right? It's based on payout. Well, it's all business, people. If you think about it, you naturally go through some version of this process with almost every aspect of your life. I use dating or whatever to be silly about it, but honestly, this is what we do. We act in a certain way. We gauge reaction. We measure the difference between what we thought was going to happen and what did happen, and then we adjust our plans accordingly. That's all we're doing here. This is just some more formalized version of it because we're dealing with money. All right. So this was represented in the columns a minute ago. I think this is sometimes confusing, but some people think the visual interaction of it. So our actual cost times our actual quantity, and our standard cost times our actual quantity. The difference between those two gives us cost variance. Our standard cost and actual quantity And our standard cost and standard quantity, the difference in those two is the efficiency variance, and the difference is the total product cost variance. Okay? Again, if this confuses you, don't worry about it too much. If it helps you visualize the difference in these things, then use it. If you want to, it's in your book, you can refer back to it. So cost variance is just how well the business manages its costs from what its planned costs were. Okay? So here they give you a little formula that we'll have to use. Actual cost times actual quantity minus standard cost times actual quantity equals the actual cost minus standard cost times the actual quantity. That's the formula you might need. All right. An efficiency variance measures how well the business uses materials or human resources. Again, here's the formula. The formula will be available to you. You've noticed in these chapters I allow you to use notes because, again, I don't think anybody is out in the middle of the Mojave Desert trudging toward a mirage or water. They're not sure. No laptop, no internet. There's probably internet out there now too. You got no bars on your phone, and you're like, crap, I've got to calculate this efficiency variance. It doesn't happen, right? In real life, you calculate these things in an office setting where you have access to tools, so that's why I don't have a problem with notes. All right. Again, I think those are confusing to look at. So here's how we use standard cost to determine direct materials and direct labor variances. Take our actual results, our flexible budget, and we look at the difference between them. It's not rocket science. Okay? This is one of those things that I hope as you look at it, even though what you're saying right now is, I don't fully understand this because I haven't tried it yet, conceptually it just doesn't look that hard, and I think once I get in there and I try it, I'll be okay, because that's the truth of the matter. All these variances is what we actually did, the flexible budget, which is based upon the standard costs, right? We take the standard cost per unit, multiply it by the number of units, and that gives us the standard expected cost or flexible budget cost, and the difference between the two is the variance. That's all. The hardest thing I think about this chapter is trying to figure out, was that a favorable variance or an unfavorable variance? And it's really simple. If it's revenue, higher is favorable, less is unfavorable. If it's an expense, less is favorable, higher is unfavorable. That's it. And then on operating income, if you're going to have that, then higher is better, right? All right. I'm trying to think of what other things in this chapter are really worth spending time on, because I think some of the way they do these slides is confusing. I'm going to get to... All right, so here standard costs are used to measure manufacturing overhead variances as well. Okay, so we've learned about manufacturing overhead. We've been frustrated by the various ways that people try to estimate overhead and how they try to allocate overhead, right? That was the first 5 or 6 chapters, or whatever it is, of different ways of allocating manufacturing overhead. All right, so overhead variance is the actual overhead cost, the difference between it, and the standard overhead allocation. I bet you could have guessed that by now. Variance is the difference between what actually happened and what you expect to happen. That's all. So in a standard cost system, manufacturing overhead is allocated to production as follows. Overhead allocation equals the standard overhead allocation rate times the standard quantity of the allocation base. Again, all of those managers get together, they say, what's the allocation rate? What's the base? What do we expect to be the volume of the base? That's our standard for overhead. That's it. For variable overhead, same thing. We break it down to some rate, right? So the variable overhead cost standard in this case is $3 per direct labor hour. How do they do that? By saying this is how much overhead we think we are going to have. This is how many direct labor hours we're going to have, dividing it out and saying that's the variable overhead standard. Same with efficiency standard. They just calculate it. So I almost feel like it's dumb, and I feel like I'm confusing you by just saying there's not much to this. In a problem, think of in a CAD problem, it's going to tell you, okay, they expect this much overhead costs, they expect this many direct labor hours. What's the standard overhead? Well, you divide it and say the same way you calculate overhead all the other time, except now this isn't based on actual numbers. It's based upon what the accountants got together and estimated. Then that standard is what you compare against the actual number. That's all. All right. I feel like there should be a problem here, but it keeps giving us these answers, but it doesn't give us the questions to the problem. I think we have to go all the way back to that chart. Fixed overhead variances, same thing. We need the actual fixed overhead costs incurred, budgeted fixed overhead costs, and allocated fixed overhead costs. Fixed overhead cost variance is the actual minus the budgeted. Same thing. So they finally give us this CVP line or graph, right? Here they compare direct labor hours to fixed overhead cost. Here's our budgeted direct labor hours. There's our standard. Then we can plot that out. And the difference here is where it's favorable and where it's not favorable. I almost feel like there's way too many slides in this chapter. It makes it more confusing than what it actually is. I'm going to move forward here. All right, so this is where we get to the journal entries, and so I will go through these. So what it tells us is that using a standard cost system simplifies the recording process because entries are made at standard costs. Variances are recorded as soon as possible when we actually know the variance. Okay, so here we go. Cheerful Colors records a debit to raw materials inventory for the standard price of the paraffin wax. 65,000 pounds at $1.75. So here's how they record it. Raw materials inventory goes up. So accounts payable. And then the difference is the cost variance. Then when they actually use the materials, then they do a work in process inventory. They record the efficiency variance, and they record the amount that they reduce. You'll see in a minute how these all come together. Same with the work in process. Same with the overhead. Same with the overhead. There's where they move it to finished goods. Then they sell it. Now they adjust the manufacturing overhead. They take all of these variances at the end of the process and they debit them to overhead. What would happen if you had a variance on the debit side? Actually, we did have variances on the debit side, so we credited them to take the variance back to zero. And we debited overhead. So what would happen if we had variances on the credit side? What would you guess? Yeah. What would we do with them? We'd debit them and then we would credit manufacturing overhead. So it's just closing them out at the end of the period. Okay. So in essence, with standard costing, what you're doing is you're saying, I'm recording at what I expect things to be. And then if there's any difference between what I expected them to be and what they actually were, I record that as a variance. I do that for the whole period, and then at the end of the period, I do an adjusting entry to close out the variance to manufacturing overhead. In the end, the numbers come out exactly the same as if we did everything based on actuals. But what it does is it lets us see the amount of variance in the journal entries. So by the end of the period, we can see the amount of adjustment we had to make, whether it be favorable or unfavorable. That's the only difference, okay? Again, I think it's harder for me to explain than it is to just do. Maybe we should just jump right into doing the work, but that's where we are. There's a summary of all the journal entries. There on the income statement, you can see they have sales revenue. Sales revenue variance gives us actual sales revenue. There's our cost of goods sold, manufacturing costs, or manufacturing cost variances to give us a total variance. Then our actual cost of goods sold, gross profit, selling and administrative expenses, and at the bottom is operating income. So I think if you're able to refer to this as you're doing a problem with it, it's not hard. And everybody's getting quiet like this seems unfamiliar. It is not way out of the territory of what you've already done, okay? It's just the variance just means the difference between what the standard cost was, the one come up with by the accountants, and what actually happened. And as you record that, those numbers will have a balance in their accounts. You use that to create the income statement, close those out to zero, you're good. Well, that's starting to smell like going back to accounting one, having to do adjustments and closing. And that's it. So I hope, I didn't mean to, I tried to skip through that stuff because I almost feel like the amount of information that the textbook author gave us is like almost overwhelming. And as you look at it, you're like, oh, I don't know what they want from me. But as you get into it, you find that it's not much different than what you've already done. So we've got about 23 minutes of class left. You're free to leave if you want. You're also free to go work on the chapter that several of you said, I'm not done with that yet. 20 minutes is enough time to log in and get a little bit of work done. It's up to you, though. Thank you, and have a great day. And I promise this chapter will not be blazingly hard.